Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Chongqing Iron and Steel Company Limited annual report. Chongqing Iron and Steel Company Limited offers a diverse range of businesses and services. At its core, the company specializes in the production and sale of steel products, including wide and thick plates, hot-rolled thin plates, raw material coils, and hot-rolled strip products. In addition to steel production, the company also provides rebars, hot-rolled plain round steel bars, construction threaded steel bars, ordinary carbon steel wire rods, and carbon steel wire rods. These products cater to various industries such as machinery, construction, engineering, automobiles, motorcycles, shipbuilding, offshore oil, gas cylinders, boilers, and oil and gas pipelines. Furthermore, the company is involved in domestic shipping, cargo, and transportation agency activities, providing a comprehensive range of services to its clients. With its extensive product offerings and logistical capabilities, Chongqing Iron and Steel Company Limited has established itself as a significant player in the steel industry. Chongqing Iron and Steel Company Limited market capitalization of 15 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that Chongqing Iron and Steel Company Limited holds a significant advantage in their industry. Chongqing Iron and Steel Company Limited trades at a higher price-to-book ratio of 0.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 53% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a given period can be attributed to several key factors. On the one hand, revenue decline is largely driven by decreases in production and sales volume across various product lines. Specifically, iron production decreased by 7.86%, steel production by 4.71%, commodity billet production by 6.63%, and sales volume of commodity billet by 6.31%. Additionally, the sales price of commodity billet also saw a decline of 6.56%. On the other hand, revenue growth is primarily driven by increases in sales volume and income from specific product lines. For instance, hot-rolled coils experienced a 5.88% year-on-year growth in sales volume, resulting in an increase of RMB0 in income. Commodity billet also saw a significant increase in revenue, with a gross margin growth of 6.14%. Furthermore, the sale of steel products such as hot-rolled sheets, plates, and billets showed notable growth rates, ranging from 6.5% to 88.2%. In summary, while revenue decline is largely attributed to decreases in production and sales volume, revenue growth is driven by increases in specific product lines and sales volumes. The net income and profit margins of a company underwent significant changes between 2024 and 2025. The net income decreased by RMB 661,916,301.84, resulting in a drop from RMB 3,195,561,486.3 to RMB 2,721,831,982.67. This decline is reflected in the net profit margin, which decreased from -0.5% in 2024 to -0.43% in 2025. The operating profit margin also saw a decrease, dropping from -0.53% in 2024 to -0.46% in 2025. The reason behind this decline is attributed to the costs associated with suspended production of certain products, as mentioned in Note 1. This indicates that the company's decision to halt production had a negative impact on its financial performance, leading to decreased net income and profit margins. The company's financial performance indicates a significant improvement in its ability to generate cash. According to the latest figures, the net cash flow from operating activities has increased substantially. In 2025, the company recorded an impressive RMB 1,648,910 in positive operating cash flow. This is a clear indication that the company is now generating sufficient cash to meet its operational needs and invest in growth initiatives. The increase in operating cash flow suggests that the company's business model is becoming more efficient and profitable, allowing it to generate excess cash for future investments or shareholder returns. The company's debt level has undergone significant changes in recent times. Long-term borrowings have seen a substantial increase of 52.92%, while lease liabilities have skyrocketed by an impressive 93.96%. Notes payable have also risen by 68.3% over the same period. In addition to these increases, short-term borrowings have also experienced growth, albeit at a slower pace of 6.1%. The company's reliance on debt has led to a corresponding rise in interest expenses, which have increased by 7.6%. Furthermore, finance expenses have seen an even more significant jump of 17%. However, it is worth noting that the company has made substantial cash repayments of borrowings, amounting to RMB 2.43 billion. While this may indicate a reduction in debt levels, the increase in interest expenses suggests that the company's financial obligations remain substantial. The company's management is optimistic about the future prospects of the industry, citing three major directions that signal a new stage of growth. Firstly, the emphasis on green and low-carbon transformation indicates a shift towards sustainability and environmental responsibility. This direction is expected to drive innovation and investment in eco-friendly technologies. Furthermore, the focus on ultra-low emission retrofitting suggests that existing infrastructure will be upgraded to meet the new standards, creating opportunities for cost savings and improved efficiency. Lastly, the research and development of low-carbon frontier technologies, such as hydrogen metallurgy, marks a significant step towards reducing carbon emissions and exploring alternative energy sources. Overall, management's outlook is one of strategic transformation and innovation, positioning the company for long-term success in a rapidly evolving industry. The company has a history of paying dividends to its shareholders. According to the provided information, the company has indeed paid dividends, with a specific amount mentioned for the year 2025. This indicates that the company prioritizes returning value to its investors through dividend payments. There are concerns about inventory buildup or supply chain disruption in the industry. The data suggests that there has been a significant decrease in inventory levels for certain products, such as hot-rolled coils, -70.91%, and commodity billet, -88.79%. This reduction in inventory could potentially lead to supply chain disruptions if not addressed. Furthermore, the issue of supply chain decoupling and trade barriers is also mentioned on page 24, which adds to the concerns about supply chain disruption. These factors can cause delays and inefficiencies in the supply chain, ultimately affecting the industry's ability to meet demand. That concludes the financial summary for Chongqing Iron and Steel Company Limited. Feel free to comment below, and I will be happy to answer them when possible.